right now in March of 2026. While most people are still debating whether silver is a good investment, the data, cold, hard, irrefutable data, is screaming that we are in the middle of the most powerful precious metals repricing in modern history. Silver already traded above $85 an ounce just weeks ago. It hit an all-time high of nearly $122 before a violent shakeout sent it tumbling 28% in a single day. And almost nobody is asking the right question. Not whether silver will go up. It already has. The question you need to ask yourself, the question that will determine whether you protect your family's wealth or lose it, is this: why is this happening and what comes next? Because when you follow the data, all of it, the supply deficits, the monetary math, the central bank behavior, the industrial transformation, and the structural rot inside the fiat system, you arrive at one inescapable conclusion: silver is not done, not even close. And the system that has kept it suppressed is fracturing in real time. Let's start with the foundation. Let's start with what the data actually says about silver supply and demand, because this is where most people stop looking, and it's exactly where the story gets extraordinary. The Silver Institute, which is the industry's own research body, confirmed that global silver demand hit a record 1.2 billion ounces in 2024. Mine supply, it came in at roughly 19.7 million ounces, growing less than 1% from the year before. That gap between what the world demands and what the ground produces is not a short-term anomaly. It is a structural crisis that has been building for 5 consecutive years. According to the World Silver Survey 2025, the cumulative supply deficit from 2021 through the end of 2025 reached approximately 796 million ounces, nearly an entire year's worth of global silver mine production gone, consumed, burned through, not recycled fast enough, not replaced fast enough, not replenished fast enough. And by the close of 2025, analysts were projecting that figure to cross 820 million ounces, one full year of global mine output in deficit in just 5 years. This is not a market imbalance. This is a market transformation. Now you might say, fine, but deficits don't always translate to price explosions. Sometimes the market self-corrects. Isn't that what happened in 2022 and 2023? Yes. And here is the critical distinction that separates this cycle from every previous one. In prior cycles, silver demand was driven primarily by investment in jewelry discretionary demand that collapses when prices rise. What is driving this deficit today is something categorically different. Industrial demand, structural, price inelastic, irreplaceable industrial demand. Industrial fabrication reached a new all-time high of 680.5 million ounces in 2024 and kept climbing through 2025. That is 59% of total silver consumption now coming from industrial use, up from just 50% a decade ago. The factories buying silver for solar panels, for electric vehicles, for AI data centers, for 5G infrastructure, for advanced semiconductors, they cannot substitute. Silver's electrical conductivity exceeds every other element. Its thermal properties are unmatched. You cannot swap it out for copper or aluminum in a solar cell and maintain efficiency. The industrial buyers are not speculating. They are buying because they have to. Let me give you the specific numbers because they matter. Each solar panel contains approximately 20 grams of silver. According to researchers at the University of New South Wales, solar manufacturers alone will require over 20% of the current annual silver supply by 2027. By 2050, solar panel production could consume 85 to 98% of current global silver reserves. That is not a typo. By mid-decade, the solar sector alone could be consuming the equivalent of nearly all the silver that exists in known reserves year after year, and this is before we layer on electric vehicles. Each battery electric vehicle uses 67 to 79% more silver than a conventional internal combustion engine vehicle, roughly 25 to 50 grams per car. The Silver Institute forecasts that EV vehicles will overtake traditional combustion engine vehicles as the primary source of automotive silver demand by 2027, reaching 59% of the automotive market by 2031. The compound annual growth rate for automotive silver demand sits at 3.4% annually through the end of the decade. On top of that, AI data centers. The European Union alone has set a target of 700 gigawatts of solar capacity by 2030. Global IT power capacity increased by 5,252% between 2000 and 2025. Every data center, every server rack, every power management system requires silver. This is not a trend. This is a mega trend with a multi-decade runway, and it is consuming silver faster than the Earth can produce it. Now, here is what makes this deficit so dangerous for the system. Supply cannot respond. Not quickly, not meaningfully. New silver mining projects require 7 to 10 years from discovery to production. Permitting delays are endemic across Mexico, which produces 24.5% of global silver supply, and Peru, which faces ongoing operational disruptions. And here is the structural detail that almost nobody talks about. 70 to 72% of silver comes as a byproduct of copper, lead, and zinc mining. Silver miners don't primarily mine for silver, they mine for other metals, and silver comes along for the ride. That means when silver demand surges, you cannot simply tell silver miners to dig faster. The primary metal economics drive the decision, not the silver price. Supply is largely inelastic and demand is accelerating. That combination, structurally inelastic supply meeting structurally expanding demand, is the fundamental architecture of a price explosion. So where does silver go from here? Let me give you the range of what serious analysts are saying, and then I'll tell you what the monetary picture adds on top of the industrial picture. Gold Silver's lead analyst Alan Hibbard expects silver to trade above $100 in 2026 as the supply deficits deepen and industrial demand accelerates. FX Empire's technical analyst Mohammed Umair, an MBA and engineering PhD who has studied the cup and handle breakout pattern that silver completed in 2025, points to a measured move that could yield a gain of over 700% from the $30 breakout level, which targets a price between $250 and $300. And his view is that the $100 level is the first major hurdle in 2026, and a break above $100 opens the door toward the $250 to $300 range. CoinCodex's algorithmic model projects silver reaching 240.74 by the end of 2026, a 184% increase from current levels. Longer-term forecasting models project silver climbing from the $190 range in 2027 toward $310 and beyond by 2032. These are not the views of gold bugs and basements. These are institutional analysts, quantitative models, and industry researchers, and they are all pointing in the same direction. But none of this fully explains what is happening unless you zoom out and look at the monetary picture, because silver is not just an industrial metal. It has always been, throughout 6,000 years of human civilization, a monetary metal, and the monetary system it exists within is undergoing the most profound stress test in modern history. Let me give you the numbers on the U.S. debt situation, because it is not possible to understand silver without understanding what has happened to the dollar. As of February 2026, the gross national debt of the United States reached $38.57 trillion. That debt is expanding at approximately $6.3 billion per day, nearly $73,000 every single second. In 2025, interest payments on that national debt consumed nearly 40% of all federal tax revenue. Think about that. For every dollar the U.S. government collected in taxes, 40 cents went purely to paying interest on old debt, not to defense, not to infrastructure, not to healthcare, not to anything productive, just servicing the accumulated borrowing of previous decades. And when you combine federal debt with corporate debt and household debt, America's total debt obligations reached $98.8 trillion in Q2 of 2025, equal to 324% of GDP. Global sectoral debt rose to $340 trillion by mid-2025, with the government share hitting a record 30% of that total. The Committee for a Responsible Federal Budget ran the numbers and found that the Congressional Budget Office in the spring of 2025 modeled a scenario where U.S. debt approaches 250% of GDP within a quarter century, not without causing a sharp contraction, a gradual crisis. And billionaire investor Ray Dalio issued what his team described as his most dire warning yet in 2025, comparing America's fiscal situation to an economic heart attack, stating openly that the country is spending 40% more than it takes in, and that debt service payments are squeezing away buying power like plaque in the arteries. This is the financial backdrop against which silver is being repriced. And central banks around the world are reading this same data and responding in a way that tells you everything you need to know about where confidence in the fiat system actually stands. Central banks purchased over 1,000 tons of gold in 2025, the third consecutive year above 1,000 tons. That is not diversification. That is a flight to safety. China's official gold reserves climbed from approximately 1,050 tons in 2012 to 2,303 tons by the end of Q3 2025, while China's holdings of U.S. Treasuries cratered from a peak of $1.3 trillion to $730, the lowest level since 2009. China is systematically selling American paper promises and buying hard assets. That is a geopolitical and monetary signal of the first order. According to IMF data, the U.S. dollar's share of global foreign exchange reserves has slipped to 56.9%, a level last seen in the early 1990s. Meanwhile, the total value of gold held by global central banks surpassed their holdings of U.S. Treasuries for the first time in the modern era. The World Gold Council noted that gold's rally to $4,500 per ounce and beyond in 2025 occurred despite higher real interest rates and a stronger dollar. Those are conditions that in every previous cycle suppressed gold. The fact that gold kept rising anyway means the market is no longer responding to traditional monetary signals. It is pricing in something more fundamental. It is pricing in systemic monetary breakdown. JP Morgan, the largest bank in the United States, is projecting gold to reach $6,300 an ounce by the end of 2026, a 30% gain from early 2026 levels. State Street Global Advisors published their gold outlook, noting that global sectoral debt at $340 trillion raises concern for investors, and that gold becomes an increasingly attractive hedge against duration risk and currency debasement. Bank of America is bullish. HSBC has a 2026 silver target of 88 points, and 57% of retail investors surveyed by Kitco News expected silver to trade above $100 per ounce in 2026. These are not fringe opinions, they are mainstream institutional positions. Now let me connect the dots between the monetary breakdown and the silver price. When central banks and institutional investors flee to gold in the face of dollar debasement, the gold to silver ratio becomes one of the most important numbers in precious metals. That ratio, how many ounces of silver it takes to buy 1 ounce of gold, has historically ranged between 15 and 50 during periods of monetary stress. In 2025, it was still sitting above 90 when silver began its explosive move. That means silver was, by historical monetary standards, extraordinarily undervalued relative to gold. As the ratio compresses, as it does in every precious metals bull market, silver dramatically outperforms gold. Silver rose nearly fourfold between Trump's inauguration in January 2025 and the end of January 2026, while gold roughly doubled over the same period. Silver always moves faster, further, and more explosively than gold in a bull market because it starts from a base of profound undervaluation. And then when investment demand piles in on top of the industrial demand that is already tightening supply, you get the kind of vertical price moves that most people think are impossible until they happen. And here is the structural threat to the system that most analysts are not talking about loudly enough. The Federal Reserve's own stress test scenarios for 2026, published in late 2025, modeled a severely adverse scenario where equity prices fall 54%, the VIX spikes to 72, unemployment rises from 4.5 to 10%, and the global economy enters a severe recession. They are not predicting this, but they are stress testing for it. The Federal Reserve's balance sheet grew from $800 billion in 2005 to roughly $6.5 trillion by December 2025, an increase from 6% of GDP to 21% of GDP. The American Prospect in February 2026 published a detailed analysis warning that the next financial collapse may find the Fed without the tools to respond effectively. Private credit markets, which have grown enormously since 2008 and are largely opaque, represent a potential contagion source. Crypto has been woven into the traditional financial system in ways that did not exist during the 2022 crash. Credit card and auto loan delinquencies, according to the Federal Reserve's own Fed's notes from 2025, rose to levels not seen since the global financial crisis. These are the pressure fractures forming beneath the surface of an economy that has been held together by debt, by money printing, and by confidence, and confidence is the most fragile thing in any monetary system. What does all this mean for your wealth? It means that the people who understand what money actually is, not paper, not digital entries in a bank computer, but a store of value that cannot be printed, cannot be debased, cannot be frozen, cannot be confiscated through inflation. Those people are moving into physical precious metals at a pace not seen in a generation. ETFs holding silver-backed exchange-traded products reached $40 billion in assets under management by mid-2025, with net inflows increasing 9% year-to-date. Institutional capital inflows into silver-backed exchange-traded products surpassed 95 million ounces in the first half of 2025 alone, already exceeding the full-year total for 2024. These are not small investors buying a few coins. These are institutions, pension funds, family offices, and sovereign wealth vehicles making strategic long-term allocations to physical silver because the math of the fiat system no longer adds up. Think about what this moment actually is. For 4 decades since 1980, silver traded below $50 per ounce, 40 years of consolidation. 40 years of suppressed price, of dismissal, of being called a relic, being called a barbarous metal, being called irrelevant in a world of digital finance. And then in 2025, something broke. The $50 level, that ceiling that held for 40 years, finally gave way. Silver didn't just break through it. It surged through it, doubled it, and nearly tripled it before the first significant correction. That is not a market top. That is a market awakening. Technical analysts looking at the cup and handle pattern that formed over those 4 decades describe the breakout as one of the most powerful structural price signals in commodity market history. Let me be direct with you about what $300 silver means. It is not a number plucked from the air. It is the result of a 700% move from the $30 breakout level, a move proportional to the 747% rally from the 1993 low to the 2011 peak. It is the result of a gold to silver ratio normalizing toward historical monetary norms of 30 to 40 when gold is trading at the levels that serious institutional analysts are projecting. If gold reaches $6,000 and the ratio normalizes to 20, silver is $300. If gold reaches $9,000, a figure that long-term bullish analysts at firms like Mint Builder project for 2028 based on continued de-dollarization and monetary expansion, silver at those ratios is far beyond $300. The structural deficit alone, consuming 820 million ounces of above-ground silver inventory in just 5 years with no supply relief in sight, with industrial demand accelerating for the next decade, makes the case that silver is repricing permanently, not temporarily. Solar alone could require 250 million ounces annually by 2030. By 2050, the scientific literature suggests solar could consume 85 to 98% of total global silver reserves. When a finite resource is being consumed by technologies that the world has decided are not optional, when the green energy transition, the electrification of transport, the digitization of everything runs through silver, you are not looking at a commodity. You are looking at the most critical industrial and monetary metal on the planet, still priced as though none of this were happening. Now, I want to acknowledge something because intellectual honesty matters. Markets are volatile. Silver's 28% single-day crash in early February 2026 is proof of that. The Federal Reserve has the ability to raise rates, to tighten conditions, to strengthen the dollar in the short term, and any of those moves will create turbulence in precious metals prices. If industrial demand slows, if real yields rise aggressively again, if a deflationary shock hits before an inflationary one, silver could retrace sharply. The short-term path is always uncertain. What is not uncertain is the long-term structural picture. 5 consecutive years of supply deficits, 6 expected in 2026, according to the Silver Institute, industrial demand growing at compound rates for the next decade, a monetary system printing its way toward a reckoning, central banks abandoning treasuries for gold, the dollar's share of global reserves at a 30-year low. These are not temporary conditions. These are structural transformations that do not reverse in a quarter or even a year. Here is the question I want to leave you with. The central banks of China, Russia, Turkey, India, and dozens of other nations have been buying gold, hard, physical, tangible, nobody else's liability gold, at the fastest pace in modern history. They are not doing this because they think the fiat system is fine. They are doing this because they know better than anyone exactly how fiat money works and exactly what happens when a country spends 40% more than it takes in year after year, decade after decade. They see what is in the treasury numbers. They understand what the debt service math means when it reaches 40 cents of every tax dollar. And they are moving into hard assets, not paper promises, not ETFs, not digital entries, physical metal. If the institutions that manage the world's reserve currencies are taking this action, if they are voting with their reserves, what does that tell you about where we actually are in this cycle? What does it tell you about the choices available to ordinary people who are trying to protect the value of their labor, their savings, their families' futures? Silver at $85, at $100, at $150, at $300, these are not fantasy numbers. They are the mathematical consequence of a world that has been borrowing against its future for too long, consuming a critical metal faster than it can produce it, and printing currency at a pace that makes every paper asset worth less with each passing year. The only question is when the realization becomes universal, and the people who move before that moment arrive are the ones who will have preserved their wealth, the people who wait for the mainstream media to tell them it is safe, the people who wait for their financial advisor to recommend physical silver, the people who wait for $300 to be obvious to everyone, will be the people looking back at 2026, at these prices, at this window, and wondering how they missed it. The data is not ambiguous. The deficits are real, the debt is real, the de-dollarization is real, the industrial transformation is real, the technical breakout from a 40-year base is real, the central bank behavior is real. The only thing that is not yet fully real to most people is what all of it means for the price of the metal sitting in the ground, in the vault, in the coin shop down the street. It means what it has always meant throughout history. When a real, finite, irreplaceable asset is being consumed, undervalued, and ignored by a world that has convinced itself that paper and digital promises are the same as wealth, they are not. They never were. And the market, as it always does, eventually will make that truth undeniable. This is the moment. The data says so.